ETF, ETF, ETF. ETFs are my favorite investments, but why are there so many ETFs that track the same S&P 500 index? In Canada, there are VFV, ZSP, and HXS, and there are also VOO and SPY in the US. In this video, you're going to learn how to read an ETF using key information like management fees, dividends, and currency hedging. Guys, it's been a while, but welcome back to another Investing for Complete Beginners tutorial. I'm Joyee Yang, a 26-year-old finance girly with 6 figures in assets. We are going to compare the ETFs together and choose the best investment that fits your portfolio and your investing goals. If you're ready to make your money work smarter for you, hit that like button and get your notebooks ready. What is an ETF? All right, let's quickly clarify what an ETF actually is, just so we're all on the same page. ETF stands for Exchange Traded Fund. For my beginners, think of it as a basket filled with lots of different stocks or investments. Instead of buying hundreds of stocks individually, you just buy one ETF and you instantly own a tiny piece of everything inside that basket. So what most investors do, including myself, is that we buy the index ETFs that track the S&P 500 so that we are automatically investing in the top 500 companies in the US like Apple, Amazon, and Tesla. You own all these top companies in just one ETF investment. In other words, index ETFs help you diversify your portfolio. Now let me show you something interesting. If we look at VFV, which is the most common S&P 500 ETF traded in Canadian dollars, the year-to-date return right now is about 2.71%. At the same time, this BMO S&P 500 Index ETF, ZSP, has a 2.85% year-to-date return. This means that if you had invested $1,000 in each of these ETFs, you would have made $271 with VFV, but $285 with ZSP. Both of these ETFs are tracking the same S&P 500 index, but they don't return the same growth. Why? Pay attention now, guys. Think about who's actually doing the heavy lifting for us behind these ETFs. In this case, we have Vanguard and BMO. Essentially, there are two different companies or ETF managers. Our job is to put our money into the ETF where we can get paid more. So there are 5 things that I check when I'm choosing my ETFs. 1. Management fees, or MERs. This is a fee you pay every year to the company managing your ETF. You don't actually make a payment, but the fees have already been priced in. I'll show you guys how to check the MER of an ETF and it'll all make sense later. Just remember that it's common sense. MER is a fee, so obviously the lower the better. 2. Dividends. Dividends are payments you get regularly just for holding the ETF. Now, not every ETF pays dividends, so it's important to check if you can earn dividends while investing in the ETF. 3. Currency hedging. This applies to Canadian investors. Some Canadian ETFs are currency hedged, which means they try to cancel out fluctuations in the exchange rate, but they often come with slightly higher fees. Personally, I avoid hedged ETFs. They can limit your upside when the Canadian dollar is weak. I'll show you how to spot this when picking an ETF, but in general, I'll stick to non-hedged ETFs to maximize long-term returns. Number 4, rebalancing. Some ETFs automatically rebalance, meaning they buy and sell stocks to stay in line with the market they track. For a super simple example, if an ETF holds stock A and B 50-50, and stock A grows more than stock B, the company will automatically rebalance it. So it will sell some of stock A and then buy more of stock B to bring it back to 50-50. It's the same rule as buy low and sell high. When the stock reaches high prices, you sell and then put it into the stock that is lower in price. Let me know if that makes sense. Anyway, this is a green flag. Number 5, underlying holdings. Always check exactly which companies are inside the ETF. Even though 2 ETFs might track the same market, their exact holdings could differ slightly. Did you write down these 5 things in your notebook? You can also take a screenshot of this list and tag me on your Instagram if you don't mind. I'd like to reshare your stories. We are now actually going to compare some S&P 500 index ETFs. Let's look at the pros and cons of each ETF together. Let's start with VFV, which is the largest holding in my portfolio right now. So MER fee, management expense ratio fee, is very low, 0.09% only. So they pay dividends quarterly. The distribution yield is 0.95%, which is basically 36 cents or 37 cents for every share that you own. Now guys, here's a pro tip for you. Most of the information you need is in this ETF facts document. So go ahead and open that. The next thing that we want to do is check whether this ETF has currency hedging or not. So what I like to do is Command F and then just search hedged. So this is hedged in Canadian dollars, so technically not hedged. As you guys can see here, this ETF is hedged back to Canadian dollars, which means that it is a non-hedged Canadian ETF. If the USD appreciates, which is what we are seeing right now, your returns are likely to be higher due to stronger USD to Canadian. So as a long-term investor, you're actually better off if you're exposed to fluctuations between the Canadian and the US dollar. Since this is an ETF that tracks the S&P 500 index, we want to check how closely they can actually track the holdings in the S&P 500 because the S&P 500 has fund managers to rebalance their holdings. So a good ETF should track the S&P 500 as closely as possible to make sure that they're keeping up with the rebalancing. So we can find this in the other document called the fact sheet, and then just Control F, track. Tracking error only 0.2%, which is a green flag. For the underlying holdings, the top 10 holdings are Nvidia, Microsoft, Apple, Amazon, Alphabet, etc. Now you know why I like VIV so much. The best part is how I can trust this fund to keep my portfolio diversified, and everything else about VIV is beginner friendly and straightforward. Another ETF that is very similar to VIV is ZSP, the BMO S&P 500 Index ETF. So ZSP, management and expense ratio, same as VIV, which is, again, peanuts. Their distribution yield is 0.88%. And then here you can see the ETF facts and fact sheet. So you can do your own research on ZSP. I personally hold VIV because when I started investing at 19 years old, that's the only option that I've heard of, so I just stuck to it. If you're a beginner investor trying to maximize your TFSA or RRSP, both VIV and ZSP are great options. Another tip that I can give you is to set up your TFSA or RRSP with a broker like Moomoo Canada so that you can minimize your investing costs. If you are planning to buy US stocks, which I do in my RRSP, Moomoo's conversion fees are way cheaper, and they're also a new broker that's regulated in Canada. They are currently giving away cash rewards up to $4,600 to new users, so if you want to buy ETFs and stocks, you can use my link in the description to get zero commission trading and free money for making your first deposit. If you have already maxed out your TFSA, or if you are investing with a taxable cash or margin account, you can consider HXS, Global X S&P 500 Index ETF. MER fees are slightly higher at around 0.11%, still low but slightly higher than VIV and ZSP. The reason why HXS could be a better fit for some investors is the dividends. So there's no dividends with HXS. Instead, they reinvest dividends back into the ETF automatically, giving you tax advantages since you don't receive dividends directly. This matters to investors who are using taxable accounts. If you are using tax advantage accounts like TFSA, FHSA, and RRSP, your dividend income is tax-free unless your dividend is coming from the US. Then you have a 50% withholding tax. But you don't need to do anything differently when you file your taxes. So instead of paying dividends, this ETF reinvests money into the fund, pushing the value of the fund higher. So this means the return of investment or the capital gains of HXS is slightly to be higher than VIV and ZSP. And as you can see on this chart, the year-to-date return of HSX is about 3.7% right now, which is 1% higher than VIV and ZSP. Currency hedging, HXS is also non-hedged, meaning you still get currency exposure. As for rebalancing, Global X manages the ETF to closely match the S&P 500 performance, but the method is slightly different since it doesn't pay dividends directly. Underlying holdings, same top companies, Apple, Microsoft, Amazon, Nvidia, Tesla, but structured differently for tax purposes. To summarize, HXS is slightly different than VIV and ZSP. It doesn't pay dividends directly. Instead, it reinvests automatically for you, which gives a higher capital gain and offers tax efficiency if it is held outside registered accounts like TFSA or RSP. Personally, I usually invest in VIV because it's straightforward, very beginner friendly, and has low fees. But if you prefer automatic dividend reinvestments to avoid getting taxed on dividend income, this might be a good choice. I have more ETFs I can explain to you guys for different investing purposes. If you like more ETF walkthrough videos like this, comment more ETFs to let me know. And don't forget to drop a like if you haven't done it yet. Guys, please give me your feedback in the comment section. Let me know if my explanation has been easy to follow in this tutorial. I tried my best to use layman terms for you guys. Hopefully this video helps you choose the right investments for your short-term and long-term goals. If you want more ETF videos, don't forget to comment down below and click this video over here to see my latest portfolio update.